Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit next week, which begins Monday, January 23rd. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family, and each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. And hope you enjoy this interview preview with William Koldus. Let's jump over to hopefully a little more positive question, and that's what was your biggest victory of 2016, and what helped set you up for that success?
Yeah, the positive is after doing 5 years or 6 years of research and having some mistakes along the way, I was positioning for the reflationary trade, which many were not. And, part of that's my mindset as a contrarian investor, but, the other part was following things from both a macro viewpoint and a bottom-up viewpoint. And, that was a very unpopular trade late in 2015, early in 2016. And because of the degree of its unpopularity, when the reversal came, it was dynamic, and it's still in progress. We've gone from a deflationary environment in 2011 to 2015. Some people say it's not deflation, disinflation. You can kind of call that whatever you like, but we've clearly transitioned to a reflationary environment, and that was boosted by the unexpected election surprise in the U.S., but also in Britain and in other places. There's been a move towards a reflationary mandate, and the stock market actually kind of reflected that earlier this year and has continued to do that. And being positioned for that has been very rewarding, and that's been my success story for this past year.
What specific positions did you see the biggest victories in that regard?
There was a number of them. I've concentrated in that sector from a macro viewpoint, but three that I'll mention off the top of my head are tech resources, which was the biggest percentage gainer. And then U.S. Steel was also a very successful turnaround, kind of deep value investment. And then Westmoreland Coal, which is a more unknown coal producer. But those were three big winners. But across the board, there was a number of companies, that had triple-digit returns in 2016 from a stocks appreciation standpoint.
In the way, you'd say, I guess, the way that what helped set you up for that success was your tracking the macro trends over a period of years and realizing from what you saw, a shift was coming from, again, deflationary to inflationary, which means, and primarily, I guess, in the commodity space. And so commodity prices were, I guess, getting depressed to enough level you realize, okay, it's time for a turnaround, and then you just played it really well.
Yeah, it wasn't easy. You go back to the early days of quantitative easing, and most people, including myself, thought it would be inflationary. And it wasn't. It actually was. What actually happened was, the U.S. was the best house on the bad block or in a bad neighborhood. So the world's capital, was recycled back to the U.S. We had a strong dollar, and we had this deflationary period, in 2011 through 2015. So, quantitative easing, did not lead to the inflationary response. It actually led to, if you look at the CRB, which is an index of commodities, it was one of the worst downturns in commodity price history. But following that and monitoring that, as a value investor, eventually you saw things that, circa 2012-13 was trading at decade lows in valuations. And then they, as they often do, they went through that and went to, sometimes historical lows in valuations. So it was, it took a lot of monitoring, but being aware of the macro picture and then, seeing the turn, you said, okay, this deflationary, disinflationary wave has run its course. Now we're here. And usually, adding to that in the last, when you look at a market And there'll be a rotation, and usually at the end of a bull market, you get a move into inflationary assets because your productive capacity in the economy is being used more, and you have inflation. We hadn't had that on a global scale, but I think we're getting that now. And obviously, you've seen a very strong stock market for the last 8 years. Been one of the longest bull markets in history. But finally, at the end of the bull market here, we're getting the outperformance of the economically sensitive assets, including this past year. Financials are really perked up, especially the last several months.
And when it comes, you talked about the cycles leading to one of the worst downturns in modern commodity history of the decades, and even historical all-time lows regarding valuations. And it makes me think about, oil is one example that I think is affected there. When prices are still down significantly, but oil dropping down into the 20s in terms of per barrel price. And I remember at that point, people were saying, well, it's going to fall into the teens. And of course, anytime things get to an extreme, people's sentiment is also extreme bearish. So they always say it's going to fall further, which from a contrarian standpoint usually means that is kind of a green flag that maybe it's time to enter. But I didn't enter into anything oil related at that time. We mentioned I already had some natural gas investments, but it's interesting. So the reason I mentioned that, so as you're watching these commodities hit decades lows and even historical lows, was it still hard to buy in at that point? Because rationally speaking, in hindsight, I think, why on earth wouldn't I have put all my money in oil at $20, knowing that surely it'll at least go to 40 again, and then you double your money? And so what was that struggle like for you when you saw those lows, or was there a struggle?
Well, I'm drawn to those situations almost, it's a challenge for me because I want to go to the outer favor assets, but the challenge there is that when fear, built upon fear, it's natural to want to stay away from out of favor assets. And you mentioned oil. Always when you're at a bottom of a cycle, you're going to get the major Wall Street brokerage houses. There's going to be a number of them that say this is a new era and this oil is going to be low forever. And instinctively that maybe that's not, if everybody thinks that way, it might not be the case. But it's hard even for me, being a contrarian investor for almost 2 decades. It's you think, well, maybe I'm not seeing something everybody else is seeing. And I think it's just natural to wait for the turn, because so many people, in this business, in this industry, have been burnt very badly, including myself, by trying to time the bottom. It's very hard to do. So it's normally that when oil was low there, you wanted to stay away.
Sure.
And that's normal, human, investment behavior, I would say.
I hope you enjoyed this excerpt from the DIY Investing Summit. If you want to hear the rest of the interview and the other 24 interviews from the summit, be sure and visit DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can click any of the links in the article or show notes to this episode, and it'll take you straight to the registration page. And remember, the summit begins Monday, January 23rd. You can still register after that, but you'll miss some of the content. So register by Monday, January 23rd at DIYinvestingsummit.com, and I'll see you there. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.